Well, welcome to the program, ladies and gentlemen. What's going on with the market? What are the 5 things that everybody should be doing now? And what's the biggest mistake that people in their 40s make about their retirement? We'll talk about all of those topics on the program. Welcome to Dollars and Cents. This is Joel Garris of Nelson Financial Planning. Dollars and Cents, Central Florida's longest running radio program, and also recently named by the folks at FeedSpot as one of the top 25 financial planning podcasts on the World Wide Web. So we're glad you've joined us for another episode of this week's program. This week we are actually sort of live-ish because we are doing the program in real time. Past several weeks we've been sort of recording on Thursday with all of the virus impact in terms of being able to get into the studio. Still not able to get into the studio. We're doing this from the comfort of my home while our good friend Tom Benson is back there handling the producer board. And so sort of live-ish, not quite, well, I guess it is live, not quite in studios yet, but hopefully that will come soon enough. Before we get too far on the program, of course, it's Sunday, Mother's Day, so we want to make sure to wish all of the mothers out there a happy Mother's Day. I'll take an opportunity to wish my mother, who is a regular listener to the program, so we like that, a happy Mother's Day. So happy birthday, Mom. Happy Mother's Day, Mom. And then also want to take a moment, of course, to wish my wife happy Mother's Day. We have 3 sons, as many of you know, and so happy Mother's Day to my wife Stephanie, and then of course her mother June. Happy Mother's Day to June. So we hope you are able to at least get in touch somehow, some way with your mother in today's world. It seems like this may be the day where people sort of break the quarantine, I guess, a little bit, considering that folks that haven't seen their mother may want to see them on Mother's Day. So we hope that regardless, you continue to stay well and stay safe, particularly during this pandemic time. And so one of the biggest questions that we are getting in the midst of all of this is what is going on with the market these days, because you've got this backdrop of just the number of cases continuing to go up. You've got 20 million unemployed in the month of April. I mean, just a massive economic problem that's been created. And lo and behold, the market is just kind of continuing to ignore it. And when you look actually at what the market's done over the course of the past 6 weeks, since the low of March 23rd, the markets have gone up nearly 30%. Just this past week, the Dow, for example, was up 2.5%. The S&P 500 was up 3.5%. The NASDAQ, which is tech heavy, that index was actually up 6% for the weekend. And in fact, since the beginning of the year, has a positive performance since January the 1st. So when you hear all of these numbers, how do you kind of sort of make sense of all of this? And certainly there's some things that we've been talking about on prior programs, and we'll get to kind of the Cliff Notes versions of that. But I think the biggest thing is it's the old adage, don't fight the Fed. Don't fight the Fed. And that's an adage that's been around for a long period of time. And what it means is simply this: when the Federal Reserve is cutting rates and stimulating the economy, it's best not to fight the Fed from an investing perspective, because the market's probably going to respond pretty positively. And that's really kind of, I think, the biggest impact on the market over the course of the past 6 weeks, where you have the Federal Reserve just getting out there in such a massive amount in terms of its lending ability, in terms of its lending authority, and in terms of its purchasing that it's doing with treasuries, that it's so big and so powerful that I think we kind of forget. And once again, that old adage that's been around for decades of not fighting the Fed is really proving to be true now in the midst of this coronavirus pandemic, because what they're doing by lowering interest rates, by getting into the market and buying treasuries, is they're continuing to hold interest rates low. What does that mean for business? Well, when interest rates are low, that means you can borrow at very low cost. If you can borrow at very low cost, then that means that you're going to be able to fund your operations at a much lower cost than what you would have otherwise been. Remember, for most companies, one of their biggest expenses besides payroll is the cost of their debt service. So what that means is if the interest rate is low, then my cost of debt service is low as well. Here's how big and powerful, and really no comparison to what the Fed is doing. Earlier this month, they proceeded to start two different programs. The first one is the secondary market corporate credit facility, and the other one is the primary market credit facility. So what does that mean? Primary market, secondary market? That means primary market, the Fed can actually buy bonds, buy corporate bonds directly from the companies that issue them at issuance. The secondary market is when you go out into the market and buy an existing bond that's already created. So stop and think about that. The primary market credit facility, the secondary market corporate credit facility, that has given the Fed the authorization to be able to actually go and not just buy treasuries, not just buy mortgage-backed securities, but buy bonds issued by corporations, either directly or in the subsequent trading market for bonds that have already been out there. That is just staggering when you stop and think about that, and such a difference with what happened back in 2008. In 2008, the Federal Reserve never did any corporate bond buying. It stuck with treasuries, it stuck with mortgage securities, and now their expansion is just so much more that I think it does really come back to that old adage of don't fight the Fed. If you're an investor trying to make sense of what's going on in the market, why is the market going up the way that it is against this backdrop of horrifically bad economic data, it comes back to don't fight the Fed. When the Fed is out there, and it's out there more than it ever has been, particularly when you look at this corporate bond stuff. And one of the things that this applies to is the case of fallen angels. Now, I don't know if you've maybe heard this term getting kicked around a little bit in the financial media, but basically, fallen angels is a term that's being used to describe companies that were at one point investment grade corporations, meaning that they had AAA rated and everything was going great with their business. Now, due to COVID, their old rating has dropped. There's about 150 billion of those bonds out there. Companies like GM or Kraft or Delta that were AAA rated, but now because of COVID, their ratings have dropped, making their bonds more on the order of junk bonds versus investment grade bonds. Investment grade bonds have great ratings, AAA rated. Junk bonds, less rated, more corporate risk. The Federal Reserve's facility or ability to do this is to buy bonds also extends to those types of fallen angels. So the thought is that if they're able to get into that market for the bonds of those companies, then that will help to make sure that those companies, in fact, can survive. That is, again, a huge step up from what was done back in 2008. When it was limited just to treasuries, just to mortgage-backed securities. It is an expansion of the Federal Reserve like no other, cementing the Federal Reserve as the leader across the globe in terms of its ability to be the lender of last resort and the backstop for many people. For businesses, corporations, and particularly those businesses that have been most affected by COVID, because being able to go in and buy their bonds even helps to provide some support. So what the market's saying is this: if the Fed's out there doing all of this with an unlimited checkbook, and that means that you're putting a lot of stimulus into the economy, so that as we start to reopen, this stimulus will be out there. It'll be doing its job, and ultimately, when you have stimulus like that, once businesses starts back up, then you will have a much greater amount of fiscal policy, monetary stimulus out there that will be like putting gas on a fire. It will absolutely drive the economy pretty dramatically. So that's the big takeaway in terms of what's the market thinking in terms of the Federal Reserve. When we get back, we'll talk about some of those other things that certainly the market has also been taking into consideration. But we'll go to these messages first. So stay tuned here on Dollars and Cents. This is Joel Garris, Nelson Financial Planning News Radio, WFLA, Orlando. Howdy, friends. Talking on the program today about what's going on with the market. Everybody sort of seems to be asking that question, given how much the market has sort of gone up over the course of the past 6 weeks, up 30% from the low that it hit on March the 23rd. And so people are saying, how could that be happening? You got 20 million people that have lost their jobs. I mean, the entire economy is looking like it's in shambles from a large perspective. And the simple answer really is, it's the old adage, don't fight the Fed. Maybe you've never heard that one before, but I assure you it's been around a long time. Here's what it means. When the Federal Reserve is stimulating the economy, lowering interest rates, in the case of what it's doing now, getting in there and buying treasuries, buying mortgage-backed securities, and now, starting this month, buying corporate bonds. First time ever we've seen that. They didn't even do that in 2008. That means that the Federal Reserve is out there making sure that markets function, making sure that there's liquidity in the economic system, making sure that things work as it normally would. And so when that happens, the market looks at it and says, well, wait a minute. Okay, that's like the 800-pound gorilla in the room. There's no way that we can't sort of go with the flow and ultimately recognize what the Federal Reserve is doing in terms of lower interest rates, in terms of purchases of treasuries, not just of purchases of treasuries, but also corporate bonds that they're in that market for as well. And so what that means is then the market is expecting that level of involvement, that level of 800-pound gorilla blank check reign that the Federal Reserve has, to be highly stimulative for the economy. And as the businesses reopen and you've got that kind of stimulus, then basically, to a certain extent, you're sort of putting gas on the fire that would start once businesses start to reopen. So I think the market's really kind of expecting that. Might the market maybe getting a little bit ahead of itself here? I think you could certainly make that argument, particularly when you look at some of the indexes like the NASDAQ that are actually positive since the beginning of the year, meaning up, meaning in a profit position since January 1st. Now, the reason NASDAQ's like that versus the broader markets that are still down about 10% from where they were at the beginning of the year. The NASDAQ is very tech heavy, and technology, those types of companies seem to be doing very well, providing the services that we're all becoming much more dependent on in today's world as we're staying at home and, for example, doing radio programs from home. That takes a lot of technology. We're using 2 different iPhones right now, one to call in, one to record. We're doing lights, we're doing Wi-Fi's, we're doing remotes. I mean, it's a whole big setup. That's technology, and companies make that stuff, and they're selling a lot more of it than they used to. So that really, the old adage of don't fight the Fed, I think, is one that certainly explains a lot of what's been going on in the market. And there's certainly some other things out there that we've talked about in previous shows. 80% of the job losses for example, so far have been furloughed, which means that unemployment is temporary. Fingers crossed that it still continues to be temporary and a lot of these businesses continue to open up. Of course, the issue there is what's the second wave look like? If the second wave of this virus becomes a large wave, then you're going to have a pretty tough reaction having a lot of these businesses continue to stay open. I think there's also a big distinction between sort of winners and losers. Obviously, hotels and airlines, that's pretty ugly stuff. The one sector that is leisure and hospitality, that sector represents about 40% of the job losses. So a lot of the job losses have been in just that single sector. Unfortunately, most of those jobs are lower income jobs. So this virus is having a disproportionate impact on lower wage, which I think is why we kind of see this push of trying to reopen, because there's many people that have certainly been dramatically adversely affected, particularly in the travel and leisure industry. Flip side, as we were talking about earlier, the tech side, right? It's a different story. It's a surge in demand. A lot of their products are being used. If businesses didn't know what the cloud was or those kinds of things, they're starting to figure that out pretty quickly, because the cloud computing makes working from home much more effective and much more easier. So larger companies certainly doing much better than small. We've certainly talked about that concept on the program before. If you're big, you've got the ability to kind of get through these types of crises a little bit better than smaller companies. Composition of the market, I think, is another factor of it. The market itself is basically made up of about 80% tech, financials, healthcare. All of those industries just so happen to be industries that are very much in demand during the course of the pandemic. Let's not forget, the checks, that are all out there, along with the various business loans that are out there, totaling over $3 trillion in stimulus. That's obviously a pretty significant amount of money out there that is helping to stimulate the economy. And then, of course, lower rates for a longer period of time. I think it's safe to say that you're not going to see much increase in interest rates anytime soon. And even if there is an increase, it's like from 0 up to like 0.25 or 0.5. I mean, it's so low, the interest rates are, that even if you start to see higher interest rates, it's still going to be an incredibly historically low interest rate. So I think those low interest rates also are a factor in it. And certainly the Federal Reserve being out there, being the 800-pound gorilla with a blank check, even to the extent of buying corporate bonds of those fallen angel issuers where they were investment grade, AAA, profitable companies that now, because of the COVID, they are now been downgraded to junk bonds. It's those types of companies, and there's about 150 billion of that corporate debt out there that fits that bill. Those companies will be the one that will most benefit from the Federal Reserve's corporate bond buying program, because it will help to sustain those bonds, the pricing of those bonds, so those companies don't get even more adversely impacted than what they are. And then with companies that are in better shape, that are in more like the technology sector, what we're seeing is that they're actually issuing debt just to have cash on hand, because if you issue debt today, you can get a very low interest rate, and that means that you're not going to have a very high cost to obtain that cash. So we're actually seeing some companies that are issuing out debt just to have the cash on hand. The reality is it's not normal to do that, but with rates so low, businesses are finding it difficult to not say, hey, we're going to go ahead and issue out some debt so that we can have cash on hand to do whatever it is that we might need to do going forward. So some interesting dynamics out there, but certainly the old adage of don't fight the Fed, I think, is the single best description or explanation as to why the market is hanging in the way that it is. When we're going to take a break. During the break, we will kind of set the stage for what investors should be doing now. What are the 5 things that investors and really anybody should be looking at in terms of their picture so that they can make sure that they're in the best possible shape going forward? So we'll cover all of that on the program after these messages here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando. Welcome back to the program, ladies and gentlemen. This is Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando. You're listening to Dollars and Cents, Central Florida's longest running radio program. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So be sure and check us out on any of our social media platforms, whether that's our YouTube channel where you can see me on the video doing the program. Of course, you'll also get a backdrop of a white door and on the upstairs of my home. And so that's one of the things that I guess we're all doing a little differently these days. Also, happy Mother's Day. Mentioned that at the top of the program, but want to make sure we mention that in the back half of the program as well. Happy Mother's Day to my mother. Happy Mother's Day to my wife, Stephanie, mother of our 3 boys. And then, of course, her mother, June. Happy Mother's Day to all of those mothers in my life, and certainly we hope that you have an opportunity to visit with your mother within the parameters of what we all have to observe with social media, social distancing these days. But if you want to connect with us on the social media side of things, you can go to our website, Nelson Financial Planning. There you'll see a bunch of different icons where you can connect directly to our channel on the various platforms that exist out there, whether that's YouTube, whether that's iTunes, whether that's Google Play, Facebook, whatever the case may be. Click on the icon that looks most familiar to you and you will get connected. So one of the things that we raised early in the program is what are some of the things that investors can be doing now to better prepare themselves in terms of the future? And so we boiled it down to kind of 5 key things that we want investors and really pretty much everybody to be thinking about or considering. And a lot of this is sort of going back to the basics. This time, we sort of all seem to have maybe a little extra time on our hands. Certainly, we're not able to travel. And I guess we are sort of able to go out to restaurants these days, but I'm sure many people aren't quite doing that right out of the gate. So there's definitely some time to take stock of some of the things about your own life and finances that we want to encourage people to do. So a lot of it is just sort of coming back to the basics, but we think there are 5 things that we would recommend folks to take a look at. And the first is to check your documents. And by that I mean the documents that typically you sign and drop in a file cabinet and sort of forget. And that would be things like your will or your trust or your power of attorney, living will. Now certainly is a good time to look at it. You'd be surprised at how folks sort of do them and then sort of forget about them. And it's always good to be looking at those every 5 years or so is sort of the general rule of thumb. So it takes this time to take a look at what that financial documents look like, and you may be surprised. Maybe there's someone in there that like, wait a minute, I don't really like that person anymore. Then you certainly want to take a look and make sure that those documents, that part of your financial house, is in order. So number 1, check your documents. Okay. Number 2, excuse me, along that same line, you want to also check your accounts. A lot of accounts that we own have named beneficiaries on them, and you want to make sure that the beneficiaries that you've named match in fact to the folks that you want to actually get the money, because regardless of what your will says, if you name somebody on an account, then regardless of what the will says, that person is going to get that account, no matter what the will says. So make sure that the beneficiaries that you've named on your accounts are in fact the ones that you want. That also relates not just to naming beneficiaries, but also in terms of how the account is titled. If it's a joint account, know that if anything happens to one person, if the account is joint with rights of survivorship, it's ultimately going to be shifting over to the other person that is on the account. So know that that's how a beneficiary is named on an account works, or how you have titled the account. So number 2 on this list is to make sure you check the accounts and dig deep into what that actually looks like in terms of who's named on the accounts. Another thing to be thinking about is that given that where the markets are, the markets are certainly down, even though they're not down as much as perhaps they were 6 weeks ago, they're still down. And so it may present an opportunity for you to sell assets that are at a lower tax cost. So if you've got maybe an annuity that you have been trying to get out of because of the high costs, the high fees, the significant restrictions that typically exist on an annuity, you may find that with this decline that you may be back to the point where you are at the original amount of money that you put in. Now this notion would apply not to a retirement annuity, it would apply to an annuity where you put in after-tax money. So let's say you put money in, put $50,000 in, and the value has now slipped down to like $55,000, and you've been waiting to get out of it because of the high internal cost. Well, if you do get out of that annuity, then you wouldn't have to have as big of a tax implication on it, because you only have to pay taxes on the profit that exists inside of an annuity. So maybe an opportunity for you to get out of an annuity. It may also be an opportunity to reduce down your allocation to a particular stock. Let's say you have a lot of shares of ExxonMobil, for example. ExxonMobil down pretty significantly. You've been looking for an opportunity to re-diversify your portfolio. Now is certainly an opportunity to be able to do that. And along those same lines, in terms of lower tax costs, something to look at in terms of options may be converting some portion of your IRA over to a Roth. We're at historically low tax rates, so that's always something worth considering. I'm not sure that we'll be at historically low tax rates for forever, given that at some point somebody's going to have to stop and figure out how we're paying for all of this stimulus that is being put into the economy during this pandemic. But the conversion of an IRA over to a Roth at a low tax rate also lower value, right? So if the account has gone down, you can effectively convert a higher amount of shares for those same dollars than you could have previously. So might be worth taking a look at whether you can adjust or sell assets at a lower tax cost. So that would be sort of the third thing to be kind of aware of. The fourth thing, again, thinking about non-retirement accounts, is the ability to harvest or generate out tax losses. Let's say you put $10,000 in, the value is now $9,000. If you move that into a similar position, and it's not a situation where we encourage people to get out of the market, because that doesn't make any sense, but the reality is that if you move it to a similar fund, then you can take that paper loss and convert it to a realized loss that you can in fact use on your taxes. So that's an opportunity to recognize tax loss. That would be sort of number 4 on the list. And number 5, of course, is take advantage of the sale, if you will, that's in the market, whether it's additional cash that you might have. I would encourage folks to put that in slowly over time, sort of dollar cost average, because at the end of the day, this pandemic is still very much with us. And so we do believe that there'll be plenty of volatility ahead in the market. So by sort of putting money in regularly over time, you help to smooth out those types of volatile periods of time. And then so when you fund your retirement account or you invest money generally, you buy more shares when the market is down, and thereby you're sort of leveraging your ability so that when things turn around, as the market continues to go back up, then you wind up having a more profitable return because you bought stuff when it was low. So certainly some things to be thinking about for every investor or every person really out there. And number one, you want to check your documents, particularly if they've been sitting in the file cabinet for a while. You want to check your accounts, know who the beneficiaries are. You want to think about tax loss opportunities in terms of selling assets or maybe doing a conversion. Number four, take a look at non-retirement accounts and harvesting tax losses. And then, of course, lastly, make sure you're continuing to fund your retirement accounts as best you can. We understand many people may not have that option if they've been laid off, but those that still can, we certainly want to encourage you to do that. And then as part of that, with the folks that have extra cash, extra money just kind of sitting around, there's a lot of that out there. It's certainly not making much in terms of interest sitting in the bank. So maybe you look at potentially putting that money into the market over the course of time to sort of smooth out, dollar cost average that investment to smooth out the overall volatility of the market. So some things for every investor to be thinking about. We're going to take a break. When we get back, we're going to come to the biggest mistake that 40-year-olds are making with their retirement. We'll talk about that when we return here on the program Dollars and Cents with your host Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando. Howdy friends, Joel Garris of Nelson Financial Planning here on Dollars and Cents on News Radio WFLA. On this segment of the program, we're going to tackle the question of what's the biggest mistake that 40-somethings are making with their retirement. And when you look at the numbers, it's actually pretty staggering when you look at the percentages of 40-somethings that are doing this, that is just absolutely ruining their retirement. And what is it that we're talking about? Well, nearly half, 46% of 40-somethings actually take money out of their retirement accounts. That's a pretty staggering number, and certainly one that is fraught with not just tax implications, but investment implications, retirement implications across the board. It's just too easy sometimes to grab money out. And if you're doing that, and you're doing that before 59 and a half, the cost is just tremendous, right? Because when you take money out of a retirement account, that's taxable. And what's happening then is when you report that taxable income basically winds up coming in at your highest taxable income bracket, right? Because you still sort of made your normal income, but then you took money out of an IRA or 401k, and now that is extra income that goes onto your return. So that's all going to be taxed at the highest marginal rate. The other important consideration is that, again, you're not 59 and a half, so that's probably going to be subject to a 10% penalty for that early distribution. So now you've got taxes, now you've got 10%. It's not uncommon that the total amount of taxes that you have to pay add up to at least a third of the amount of money that you took out. I don't know about you, but a 32% or 33% tax rate on anything is a pretty high interest rate to apply when you're trying to use money. The exceptions, there are some exceptions to avoiding that 10% penalty: first-time home purchase, medical, things like that. But the reality is that beyond just the tax cost, which is a significant chunk, you've got the opportunity cost, right, of that money that could be invested for another 20 years. We'll give you a very simple example with some numbers. So let's say you took $5,000 out for a down payment on your first house, okay? So you took $5,000. The reality is that it was a first-time home purchase, so okay, fine, you were able to avoid the 10% penalty, but you still were in the 22% tax bracket, so you had to spend $1,000 to get that $5,000. If you have that $5,000, the opportunity cost on that, remember, if we use just sort of a 7% growth rate, which is comparable to what the markets typically have done over a long period of time, then that $5,000 over a 10-year period of time is going to turn into $10,000. And then over a 20-year period of time, that's going to turn into $20,000. So that $5,000 that cost you $1,000 in taxes when you did it, also, you lose the opportunity for that money to continue to stay invested and continue to grow. And over a 20-year period of time, if you're in your 40s trying to retire by the time you get to your 60s, that's certainly 20 years. That has the potential to be equivalent to $20,000. If you're in your early 40s and thinking it's more going to be back in your 60s before you retire, well, that's 30 years. And now that $5,000 that you took is now worth $40,000. So understand, it's not just about the taxes that chew away immediately when you take money out of a retirement account, but it is also that opportunity cost that can be much more significant, particularly if you're in the group of folks that are using their retirement accounts at their early 40s. That's clearly the single biggest mistake that 40-something-year-olds are making with their retirement, particularly when you consider that nearly 46% of those in that age group are, in fact, doing that. So a loan is a little bit better option if you've got a 401k because you avoid the taxes on it, you avoid the penalty on it, but you're then just wind up replacing that money through those loan payments. And so what that means is that that's better because you avoided the upfront tax costs, but you still miss out on the opportunity costs to have that chunk of money continue to be invested in your account. So it's certainly important to be able to make sure that you are not just paying a bunch of money in taxes, but also missing out on the opportunity cost. So obviously, in light of today's pandemic, that everything sort of has gone out the window, making it very difficult for folks to be in good financial shape. So understand, if you have to do this in light of what's going on, the folks in Congress have actually made it a little bit easier. They waived the 10% penalty if you're using retirement dollars for your financial support because you've been affected by COVID. But just understand that it is quite costly, whether it's the taxes, but also more importantly, I think the thing that people sort of forget is the opportunity cost. If you're in your 40s, that money can stay invested, can stay growing for another 20 or 30 year period of time. $5,000 over 30 years, potential to be $40,000. That's a tremendous difference in what your retirement picture looks like. So make sure you've explored all possible options before you hit your retirement accounts. Whether that's trying to work with your lenders. I think next week on the program, we're going to be talking about some of the financial strategies you can do to try and reduce down your current expenses, and also some of the things that you can be doing to help put yourself in better financial shape to sort of get through this period of time. But the bottom line is that once this period of time passes, one of the things that we want to urge folks to really do and to take some time to do is to really start an emergency savings account, right? Make it 3 months, better if it's 6 months, but certainly the notion of having an emergency savings account is pretty important because it's that type of an emergency savings account that will in fact get you through unexpected periods of time like what we're having now. So certainly if you've been affected, you don't have much choice. The reality is, though, that you really want to turn to your retirement accounts as the last possible option, not just for the tax costs, but also for the opportunity costs. And even before, the statistic of that we were quoting of 46%, nearly half of all 40-something-year-olds taking money from their retirement accounts, that was a survey that was done earlier in the year, so long before any of this coronavirus stuff had come to pass. So the bottom line, though, is once this situation passes, then to really focus on making sure that you've got some kind of an emergency savings account built up so you don't have to go through that process. That was something that nobody was really doing, particularly when you look at the statistics where nearly half of all 40-something-year-olds were using their retirement accounts to help fund just normal expenses. So the cost is very, very high, whether it's your tax cost or whether it's your opportunity cost. So you've really got to figure out a way, particularly once things return to normal a little bit more, is to really look at ways to build an emergency savings account so that you've got money that you can access, that you can use, so that when these times come, that you don't have to hit the retirement accounts, because it's just too easy to do that. It's way too easy to do that, and at the end of the day, you just sort of only see the tax costs, which is something that you would see, by the next tax filing deadline, but you don't see the opportunity cost, and that opportunity cost of that money to grow compounded over a 20 or 30 year period of time becomes a tremendous hit to your retirement. So certainly something to think about. Hopefully folks can avoid that very common mistake as it relates to your retirement accounts, particularly if you're in those younger age brackets. So anyway, we will wrap it on up and get on out of here. And thank you all so much for listening to the program. And we'll of course be back next week on, I guess that's coming up very soon, back half of May, here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio WFLA Orlando.